Good day, investors. If you've been watching Micron the last few weeks, you've seen the stock give back a solid chunk of its massive run. Over the past month, it's down about 12%, and in the most recent session, it closed around $921 after dropping nearly 7%. A lot of people are looking at that red chart right now and getting nervous. I'm looking at the exact same chart and seeing one of the cleanest buying opportunities we've had in this name all year. Today, I'm going to break down why I'm still very bullish on Micron, why this recent dip is mostly noise rather than a real change in the story, and why the fundamentals right now are honestly some of the strongest I've ever seen in the memory sector. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Now, let's put this recent move in proper context. Micron has been one of the strongest performers in the entire market over the past year. At its peak, it was up more than 700%. That kind of parabolic move almost always comes with sharp pullbacks. What we're seeing right now is classic digestion after a massive run. The stock pushed into the high 1,100s and even tagged the $1,200 area, then started rolling over. Over the last month, we've seen elevated volume and some heavy selling, taking the price back toward the low 900s. But here's the important part. Nothing in the underlying business has broken. In fact, the exact opposite is true. Just a few weeks ago, Micron reported its fiscal third quarter results, and they were nothing short of exceptional. Revenue came in at $41.5 billion. That's up 74% from the previous quarter and up an incredible 346% year over year. Gross margin hit 84.9%. Operating income was $33.7 billion, and non-GAAP earnings per share came in at $25.11. Just to put that in perspective, these are not normal memory company numbers. These look more like high-end software margins. Data center revenue alone exceeded $25 billion in the quarter. That's an annualized run rate of over $100 billion. And data center SSD revenue more than doubled sequentially, crossing $5 billion. Now look at the guidance for the current quarter. Micron is guiding for revenue of $50 billion, plus or minus $1 billion, gross margin of approximately 86%, earnings per share of $31, plus or minus $1. They didn't just beat expectations, they're accelerating. So the earnings were excellent. But the real story goes deeper than just one strong quarter. The memory industry has been fundamentally transformed by AI. Micron's management made it very clear. Demand for DRAM and NAND is still running significantly ahead of supply, and they expect these tight conditions to persist beyond calendar 2027. Why? Because adding new supply is extremely difficult right now. Building new greenfield fabs takes years. Process technology is getting more complex with every new node. High bandwidth memory, HBM, consumes a disproportionate amount of wafer capacity. And many suppliers are even redirecting cleanroom space from NAND over to DRAM. On top of that, AI systems, whether they use GPUs, ASICs, or custom chips, are all heavily dependent on the memory subsystem for performance. Bandwidth, capacity, and latency have become just as critical as the compute itself. This is not a normal cyclical upturn. This is a structural shortage driven by AI, and Micron is one of the best positioned companies to benefit from it. Now here's one of the most important parts of the story that a lot of people are still underestimating. Micron has signed 16 strategic customer agreements, or SCAs, with major customers across data center, consumer, and automotive. These are multi-year, take-or-pay style deals. That means customers are committing to buy specific volumes over several years, with pricing structures that include floors designed to protect very high margins for Micron. When these agreements are fully completed, management expects roughly half or more of the company's revenue to sit under these contracts. Just the 14 largest ones already represent about $100 billion in cumulative minimum revenue at the contract floor prices. On top of that, customers are putting up significant cash deposits and financial commitments, around $22 billion projected so far. This is a major shift in Micron's business model. Memory used to be a pure commodity business with violent boom and bust cycles. Now a large portion of their revenue is becoming contracted, more predictable, and high margin. That's a much more valuable company in the long run. Let's talk about valuation and the recent pullback. Even after the big run we've seen over the past year, Micron is still trading at a forward PE that looks reasonable when you consider the growth and the margins they're printing. The street is still very constructive. The consensus from around 45 analysts is a strong buy, with an average price target of about $1,492. That's more than 60% upside from current levels. The high target sits at $2,200. Now, yes, the stock has come down roughly 12% over the past month. But look at what we just covered: record revenue and margins, guidance that shows continued acceleration, structural AI-driven shortage that management says lasts beyond 2027, and a growing book of long-term customer agreements that are locking in high margins and revenue visibility. This is not a broken story. This is a strong business that simply ran too far too fast in the short term and is now digesting those gains. For anyone with a 12 to 24-month time horizon who believes AI infrastructure spending continues, this recent dip has improved the risk-reward, not worsened it. I'm still bullish, and I see this pullback as a buying opportunity. Of course, no investment is without risk. So let's quickly address the main ones. If hyperscaler capital spending slows meaningfully, that would hurt demand. Geopolitical or trade issues can create short-term noise. And even with the new customer agreements in place, memory pricing can still move around. Those risks are real. But right now, the evidence points to continued strength, not deterioration. The AI-driven demand is still strong, supply remains constrained, and Micron is locking in more of its business under long-term agreements. So to wrap it up, Micron just delivered one of the strongest quarters in its history, guided even higher, and sits right in the middle of a structural shortage driven by AI. The recent 12% pullback has created a better entry point without changing the underlying story. I'm still long, and I still see this dip as a buying opportunity. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.